everyone.
Hi, everyone. My name is Chris. My name is Scott.
My name is I'd like to begin by thanking the organizers of this for giving me the opportunity to address the audience. And I'd like also to wish both the organizers and the audience, of course, the very best of the holidays, the best of the season. So let's talk about where we are in the natural resource-based business. I know nothing really about the qualifications and the experience of the audience, so I'll try and do a one-size-fits-all message. The first part of the message that I want to leave with everybody is that natural resource-based businesses are capital-intensive and cyclical, which is to say they're extremely volatile, they're extremely cyclical, and I would go so far as to say that if you are not a contrarian as a consequence of volatility and cyclicality, you are going to be a victim. It's human nature in all businesses, in fact, in all facets of life, that your expectation of the future is set by your immediate past. What that means as an investor is that the validation of a narrative, the validation of a story, be it a story around natural resources, be it a story around electric metals, be it a story around gold, involves having the narrative itself being validated for you by increasing prices. The problem with relying on the increasing price structure to validate the narrative is that by the time the price structure has increased to validate the narrative, most of the profit potential in the move is gone, which is to say that you have to anticipate narrative. You have to buy a market when it's unpopular. You have to buy commodities when you think they're going to go up or when you think they must go up, rather than when they have already gone up. And as a consequence of the price increase that the narrative has been validated for you. What does this mean in real terms? It means, I think, that you find a commodity, ideally, that is necessary for the continued material well-being of humankind, which is to say one where demand is ensured for the next 20 years, where it has to be in continued supply for those of us to live the way that we would like to live. And ideally, you find a commodity, where ongoing demand is assured, but where the commodity selling price is so depressed that the industry is in effect in liquidation, which is to say that the global fully loaded cost of producing the commodity is greater than the selling price of the commodity. Why would you buy an industry in liquidation? Simply because if the price has to go up, the price will go up. And the way that you buy commodities that are out of favor is by buying industries in liquidation, buying industries where the near-term outlook is so bad that the market is on strike, but where the longer-term outlook for you is assured. So much of investing and so much of speculating is really about arithmetic and using the arithmetic, using facts to overcome your aversion to narratives that haven't yet been proven. Let's look just for fun at precious metals. Many people are expressing hesitancy about precious metals because they haven't moved. That's like saying you're expressing hesitancy because something is still cheap. It's fairly crazy. But let's look at the arithmetic behind precious metals. From my point of view, gold, as an example, competes primarily with other savings and investment products denominated in fiat currencies. Let's look at the arithmetic around the competition. The US 10-year Treasury, which is the world's benchmark savings and investment instrument, currently promises holders, and they will deliver, a 4% return. A 4% return in a currency where the government acknowledges that the purchasing power of the currency is declining at 8% compounded. What that means is that the holder of the 10-year Treasury may expect his or her purchasing power to decline by 4% compounded a year for 10 years. My friend Jim Grant calls this return-free risk. Gold, then, is competing in a very real sense with return-free risk. Can gold win? I think so. When? I don't know. But the fact that it is still relatively cheap, to me, makes it more rather than less attractive. Let's apply the same narrative to uranium. It's estimated worldwide that the total cost of producing uranium, including not just AISC, but cost of capital, social rents, and importantly, write-downs of prior year projects, unsuccessful projects, that the total cost of producing a pound of uranium is $60 a pound. And we sell it in the spot market at 48, losing $12 a pound on 130 million pounds a year. Not a very good business, a business, in fact, in liquidation. In less trouble than it was 2 years ago or 3 years ago, but still in trouble. But ongoing demand for uranium is assured. It's a carbon-free source of energy, even in countries that believe that they can afford to do without it, like the United States. Uranium accounts for 13% of electrical generation and 20% of baseload generation. If the price of something can go up and must go up, it will go up. Will it go up in a time frame that suits you? That's up to you. It's not up to the market. And you need to adjust your time frames, not to reflect your own preferences, which the market doesn't care about, but rather to accommodate you to take advantage of the opportunities which are being offered up to you. I've benefited really late in my career by understanding that when I ask myself questions that begin with the word when will the price rise? When will this happen? When will that happen? That while the when can be frustrating, it's a better question than I ask myself a question that begins with when. When is better than if. It is true that a circumstance that is inevitable isn't necessarily imminent, but the thought from our own point of view that those two words need to be exactly correlated is exactly wrong. My belief is that as a species, we have underinvested in natural resources for a very long time. And in many mineral commodities, many extractive industries, we're going to face a supply cliff. How soon that supply cliff occurs is really a function of the broad economy. If we have a synchronized global recession in the next 5 years, obviously supply can fall if demand can fall, and it won't make any difference to supply. But understand that that just delays the supply cliff. It doesn't eliminate the supply cliff. So across the whole range of natural resources, understand that we have underinvested as a society. Understand that there's going to be volatility and that there's going to be cyclicality. And understand, too, that the primary determinant as to whether you succeed or whether you fail is you. The markets are beyond your control. The government response is beyond your control. The public narrative is beyond your control. What is in your control is how hard you work, how intelligently you act, and how patient you are. Once again, best of the holiday season to you and yours. May you apply these rather obvious lessons to making your future more prosperous than it otherwise would have been. Thank you.
Hi everyone, this is Peter Kraut from Silver Stock Investor. I want to tell you about my outlook for 2023, not just about silver, but markets in general. So I think that the first thing to look at is that central banks will stop hiking interest rates and maybe even cut them later in the year. I think stocks and bonds are likely to remain weak in the first half of 2023. I also think precious metals and commodities will rally in the second half of 2023. And finally, I think silver will remain strong and rally thanks to multiple drivers. Let's look first at central bank rate hikes. The US has been hiking rates very aggressively throughout 2022, and we now are expecting them to start easing on that. So I think that rates will likely peak in the first or second quarter of 2023 as the Fed finally pauses and they see inflation back off somewhat. I think inflation in this cycle is likely to fall back, but it's going to probably remain high in the 4 to 6% range as the effects of rate hikes kick in. And I also think we're going to see a mild recession by the middle part of 2023. So with all of that, I think stocks and bonds will continue to remain somewhat weak from now until probably in the end of the first half of 2023, as the high interest rates continue to weigh on them. But eventually, I think something will break and we're going to see some sort of a financial event take place in the first half of next year. And I think that will likely trigger new stimulus, not only rate cuts perhaps, but also new stimulus from central banks and governments around the world. And that will likely lead to rallies in stocks and bonds in the second half of next year. I think precious metals and commodities, if we look at this sector, precious metals are likely to stay robust as the dollar has likely peaked again for this cycle and remain weak because of expected Fed rate hike pauses coming in the sort of middle part of next year. I think the industrial commodities will face more headwinds and they could weaken along somewhat with the economic outlook. But as I say, I expect some kind of financial event in the first half of next year to come along and trigger rate cuts. And so I think precious metals and commodities will certainly rally in the second half of next year. Through all of this, I think silver will remain strong and continue to rally. Silver remains cheap historically, but also versus gold. If we look at the gold-silver ratio going back several years and even decades. But remember, if you look at the supply-demand fundamentals for silver, silver is expected to see demand up 16% this year. It's going to be that's going to bring it to new record demand highs. Supply will only grow by 2% versus demand's 16%. And so I think the deficits that are reaching all-time records this year of 194 million ounces is what's forecast for a supply deficit in 2022. I think that will continue next year, perhaps not quite to the same extent, but I think we're going to see very, very big deficits continue next year and through several years ahead. The industrial and investment aspects of silver demand will very likely continue to grow in 2023. And so because of all of that, I think silver could reach as high as $25 in the first half of 2023 and as much as $30 in the second half of next year. These are all things that I talk about in my recently published book, The Great Silver Bull. You can find it on Amazon in paperback and in Kindle. And if you want to follow my work and if you enjoyed this video, click the like button, you can subscribe, and you can follow me at silverstockinvestor.com. I'm also on LinkedIn and on Twitter, and look forward to a strong year for silver, gold, and commodities, especially in the second half of 2023.
My outlook for gold in 2023 is the brightest it's been in years. This big bull market began when gold rallied off a 20-year low in around 2001 when it was below $300 an ounce. The low was around 260, and it went on a 10-year run that saw the price of gold hit around 1,900 an ounce back in 2011. Then we went into a multi-year bull market correction that didn't bottom out until December of 2015 when the Fed for the first time raised interest rates above zero. It had kept them at zero ever since the 2008 financial crisis. Well, since that bottom in December of 2015, we've had a slow and steady rise. We ultimately took out the 2011 high in 2020. We've had a correction since then, and I think now gold has built a solid base and is getting ready for the next major leg up that will mirror the big increase we had from 2001 to 2011 and may even eclipse it. I think the catalyst for the next big move up in gold is going to be the realization that inflation is never going to return to 2%, at least not in the immediate time horizon of anybody who's alive today and making investments, certainly within the time span of the duration of a 30-year U.S. Treasury. I don't expect inflation to come back down to 2%. I think the average rate is going to substantially exceed that because I don't see the political will to actually do anything to rein in inflation because the entire policy of the U.S. government, the Federal Reserve, and Congress has been inflation. Every time the economy has been in trouble, the solution was create inflation. Quantitative easing, that's just another way of saying inflation. It's just not as bad sounding to the typical American who would object to a policy of inflation. When you disguise it by referring to it as quantitative easing, well, the public doesn't object. But every time there has been a problem, whether it's been in the markets or the economy, the Fed has rushed to paper it over with inflation. And Congress, all these guys want to get reelected, so they want to promise the voters something for nothing. And the way they pay for it is through inflation. We are running massive budget deficits. All of that government spending has to be paid for. And if it's not going to be covered by legitimate taxation, it's going to be covered through creation of money, which is inflation. So I think inflation is here to stay. And the fact that it's already broken out to 40-year highs, in fact, all-time record highs, if we measured it properly. But even with the deliberately rigged metrics that we use, like the CPI, the inflation rate is now so high that government can't hide it anymore. And I think the inflation that has already been created is in the process of moving from financial assets to real goods, consumer prices. And I think the new inflation that's going to be created is going to bypass the financial markets and go directly to consumer goods. And I think that's going to happen when the current recession, which is mild, I suppose, becomes far more severe and leads to another financial crisis. Then the Federal Reserve will do a complete U-turn on its inflation fight. It will concede and go back to quantitative easing and rate cuts, which will fuel the inflation fire. And I think that will result in a massive increase in the price of gold and silver, well beyond the 2020 high of just under 2,100 an ounce. I think the price of gold is going to go up several fold from here. I have no idea where the ultimate top is going to be, because I have no idea where the bottom in the dollar is, because they can create as many dollars as they want. And so since there's no floor to the value of the dollar, there's no ceiling to the price of gold. But I would suggest that investors get fully positioned now. I think the recent decline, which resulted from the misconception that the Fed was going to be victorious in its fight and it would fight inflation as hard as it needed to, and it would keep on raising rates. And the fear of this inflation fight is what scared gold investors out of their positions. Well, eventually they're going to stop fearing the inflation fight and fear inflation itself, because they're going to recognize that it's inflation that's going to win that fight, that the government is going to concede. And so you want to buy your gold and silver now, but more specifically, if you really want to make a lot of money off the rise in gold and silver, you should be looking at the equities. The gold and silver mining companies are a highly leveraged way to bet that the price of gold goes higher. And not only do you get the upside in the metal, but you get the income of operating companies that is paid out in dividends. And I think a big increase in the price of gold is going to lead to an even bigger increase in the bottom line of the companies that mine it, and lead to oversized increases in their dividends. And that's what investors need when the tech bubble deflates, when we go from a low inflation, low interest rate environment to a high inflation and a rising long-term rate environment. That no longer favors.
Hi, everyone. Jeff Clark here at thegoldadvisor.com, and I hope you enjoyed the conference. I was asked to give my thoughts on what I expect in 2023 and how I'm investing. So I hope you find this useful. There's three things I want to say about 2023. The first is a little different, but I don't think you can prepare for 2023. Now, what do I mean by that? Well, if you look at all the crises that have occurred over the past 50 years or so, and you just list them all and you look at them, roughly half of those were black swans. In other words, they were events that occurred that people weren't expecting, that investors didn't plan for or anticipate. And these events caught people off guard, and it caught investors off guard. So if half all the events out there, or the crises out there, are black swans, that means that if that occurs in 2023, it's not something that you would necessarily know is coming or can plan for it or predict it. And so that argues, until the monetary system is changed, that argues that we need to remain long gold. Gold is the best hedge against those kind of events. It's our best defense. And until the monetary system is changed and becomes much less volatile, we need to remain long gold. And so for 2023, there's no change in the thesis for owning gold. You still have to own a meaningful amount, in my opinion. Secondly, it's hard to look at 2023 and not consider what the Fed may do. I don't like having the, being forced to look at what the Fed is going to do, but that's the reality. So, and the big, event probably in 2023 will be a Fed pivot. So, in my opinion, based on history, I don't think it'll be just them stopping raising rates. It'll actually be a full pivot where they begin to actually lower rates again. And this is based on their 70-year history. The average time period from the last Fed rate hike to the first rate cut is only 5 months. That's the average over the past 70 years. I think that happens in 2023. They'll be forced to because of all different kinds of events, problems that they could cause, whether that be a stock market crash, some kind of bond or a credit event, a recession, or worse. There's a lot of things out there that could happen because of them continuing to raise rates. And that doesn't necessarily bring inflation down either, by the way, because most of the inflation right now is due to supply chain issues, as we all know and everybody's talked about. That's the real issue with inflation. So as it comes down, is probably more likely a result of, yes, continued lower demand, but resolution of the supply chain, and that's why. What am I most bullish on? This is the third thing I want to talk about for 2023, and that is the only commodities out there that haven't spiked are uranium, silver, and gold. And I think they will. I think that process gets underway strongly in 2023, and that's where most of my capital is going to, by the way. So I'll be investing in the equities surrounding those three metals, primarily uranium, silver, and gold. I do have some exposure to copper and some exposure to lithium. It's very small in comparison, but I think the supply-demand issue there with those two metals is very compelling. We'll probably be adding some stock picks there too, by the way, from them here in 2023. But make no mistake, I'm going to be remaining very long on gold, silver, and uranium equities. All my picks are listed at thegoldadvisor.com. It's free. As some of you may know, I was a newsletter writer for many years for multiple different publications. I still am. But I decided instead of being another newsletter writer, charging a subscription service, which is a lot of work, quite frankly, I wanted to make everything free. And so at the website, everything is free, but it is a sponsorship model. So the companies are paying for it as opposed to you paying for it. It's a little easier on me. It's a little quicker. It can move faster. It's more fun, quite frankly. And of course, it's better for the investor because it's all free. You do have to sign up for the subscription, subscribe to the newsletter, but again, it's free. And so all my picks are there. I've been a metals and mining analyst since 2007. I still work a little bit with Mike Maloney at goldsilver.com and with Steve over at silverchartistadvisor.com. But 90% of what I do is going to be over at my own site now. And last, for 2023, I have a personal big announcement coming. So at the end of January, you'll see a very big announcement coming from me, both on the website, on Twitter, at conferences and things like that. Those of you who like to pick your own stocks may find this announcement very interesting. That's all I can say for now. So, okay, well, I hope this was useful. And the best way to be ready for 2023 is to make sure you're long gold and to pick the stronger equities. Because if we're right about where gold and silver and uranium are going, the equities will follow them. The stocks will follow them. They don't necessarily follow what the general market is doing, what the economy is doing, and that kind of thing. So if you want to invest in those, you want to watch what gold and silver and uranium are going to do, because that's where the equities are likely going to follow. So hope that's useful, and we'll see you all around a lot in 2023.
Dear resource speculator, I'm greeting you that way on purpose because I think that in the post-Lehman world, all investors are speculators, and the advantage is to those who know it. And if you're watching this video, you're probably interested in gold, silver, other metals, natural resources, oil and gas, the whole gamut. So here at tax loss season, looking forward to 2023, I have a few simple messages for you. One is, in this uncharted waters environment that we are, beware of the chartists, beware of the people like Fed Chair Powell, who will even say those words, uncharted waters. And then yet he'll whip out his chart and says he knows what he's doing and where we're going. Topsy-turvy world. Be very, very careful. But that, as the yin-yang sign tells us, that same caution and chaos opens up the door to opportunities. Specifically, I think trends to watch for in 2023 are the recession. I do think that central banks, even though they seem to be lightening up on the brake pedals, I do think that what they've done already will cause a recession. Right or wrong, that's not what I'm weighing in on. I'm just saying I think it's going to cause a recession. I think even if they stopped tightening now, it would be too late. And I think that has implications for all investments. I also think that inflation will be more stubborn than they imagine. Even Jeff Gundlach, who's generally pretty good on these things, is thinking inflation will go down to 4%, 4.1% by mid next year, mid 2023. I think that's pretty ambitious. I also think that to the degree that it's going down, a lot of that is base effects. You subtract last year's inflation from this year's inflation, it's harder for it to be as high. That doesn't mean things are getting better. It certainly doesn't mean that things are getting cheaper for consumers, which goes back to the first point. So I'm not one for crystal ball gazing too much, but it's hard for me not to see what's happening now being recessionary. So beware of that. A countervailing trend, however, is China reopening. After years more shutdowns than anybody else had, there's a big question mark of how much China reopening, which is already starting, will impact the global economy and our investments. Not just that China consumes most of the resources that we typically speculate on, but their impact on the global economy. I'm not willing to say that China can single-handedly save the global economy from recession, but it is something to think about, that it's a countervailing force. Going into winter, after the Chinese people have been terrorized, made fearful for years, I don't expect this to be an immediate overnight kind of boost. But as we get into spring and the reopening is already happening, the restrictions are already coming off, I can see that being a major factor, both in terms of economic activity picking up, internal demand within China, and the Chinese traveler that's been absent from the world stage for so long. There's got to be a lot of people there of the nouveau riche who have been lamenting not being able to fly to Paris to buy the latest Louis Vuitton purse or whatever it is. So interesting times, interesting consequences. An aspect of this that I think everybody needs to keep an eye on as well in 2023 is what I call the wrong trousers. That's the DXY dollar index. Or more broadly, we could refer to my friend Brent Johnson's dollar milkshake theory. I know that gold bugs don't like the dollar milkshake theory. They think it's anti-gold, but Brent's just pointing out a mechanism about how international monetary flows affect things, including the dollar and foreign exchange, and that impacts other things like competitors to the dollar, like gold and the euro and other things. So the dollar milkshake mechanism is not anti-gold. It's only anti-gold when it says that the dollar should be rising. What I'm suggesting, and I've talked to Brent about this, and there are scenarios that we could see potentially in 2023 where the dollar milkshake mechanism would reverse for a time. I think that would be very, very good for monetary metals in particular and commodities as well. So I'm not being very helpful here, am I? I'm saying on the one hand, we've got this global recession shaping up. On the other paw, we've got China reopening, maybe a reversal of the dollar milkshake mechanism. Specifically, that is, my view is that the Fed led the way in tightening. If the Fed leads the way in easing up, other central banks could be relatively tight compared to the Fed. And that could whack the DXY. That could then boost other things that compete with the dollar, like gold and other things. So we'll just have to see. I wish I could tell you this is what will happen in 2023, and I'm sure other people will. The problem is if they convince you, they sound so sure, and their secret sources in the CIA assure them that everything is great. And what if they're wrong? I prefer not to be wrong. What I'm telling you, though, is that however this balance is, I think it's probably good for commodities writ large. I think the inflation, with or without the recession, my base case is actually a stagflationary scenario. I think as the recession really looms big and people start talking about it happening now instead of being in the future, that will whack industrial metals, commodities writ large. But then people will realize that inflation hasn't gone away and that the recession hasn't cured the inflation the way that the mainstream economists say. That the central banks are trying to rein in the economy, trying to destroy jobs, even though they say it nicely, to try to slow down inflation. What if they succeed? Well, that's not so much a what if. They will hurt the economies. What if they do, but it doesn't help inflation as much as they think it will? Well, then we end up with stagflation. Then you can have commodities prices remain high because always and everywhere, monetary phenomenon, despite central bank action. And don't forget fiscal policy. The central banks could be serious and sincere about fighting inflation and do all they can to throttle the economies to drive prices lower. But it may not help if the fiscal response is, oh, those poor people, this recession is no fault of their own, so we need to send them more stimmy checks. Is that crazy? Could that never happen? Just look at the UK. We've had contradictory policies right recent in our experience to tell us this can and probably, I think, will happen once voters start crying out in pain, much more than they are already. Okay, so enough wool gathering. Countervailing forces, I think it's good in the mid to long term for commodities anyway. I think we're in a commodity super cycle that may get a bit of a pause with the looming global recession. And the exception, there's exceptions, I would say. The monetary metals can get different on here than just commodities. Gold is not like pork bellies or coffee or even copper. It is money. Famous Morgan quote, everything else is credit. And even the central banks, which have been hoarding gold in record amounts recently, seem to admit that gold is money, even if they won't say so in so many words. Not only that, it is one that can't be printed, can't be copied. With gold 2.0, doesn't exist. And it has that safe haven mantle as well. So the very recession that could hurt other commodities near term could boost gold and silver, which is also still a monetary metal, just as fear drives people into safe havens that can't be printed. So I'm bullish on the monetary metals near term. I'm also bullish on uranium. Now, broadly, I don't want to get into the whole oil patch in the energy sector too much. Clearly, it's vulnerable to the onset of the recession. Clearly, the new Iron Curtain going up as a result of the war and the deglobalization is bullish for energy prices after the onset of the recession. But uranium is different. Uranium, unlike almost any other commodity, is still below the incentive cost for production. There's not enough mine supply to meet demand now, let alone the growing demand from scores of reactors being built around the world. So I like uranium a lot. I'm not going to give stock picks because I think it's dangerous to listen to people who tout stocks. You got to wonder why they're giving you a free stock pick. You're welcome to come check out independentspeculator.com. And rather than give you a hard pitch, I'll just say if you sign up for our free weekly newsletter, we will not spam you with a flood of daily advertisements. You'll get one email per week, tells you what I'm thinking, and then you can decide if you want to hire me to be your due diligence guy in my paid publications. But that's how I see things. We'll see soon enough I'm right. Thank you very much.
Hi, my name is Jeff Hussey, President and COO of Osisko Metals. We started the company in 2017 searching for critical base metals. In 2018, we acquired Pine Point Mining Limited, and we've been advancing that project for the last 4 years. This year, we put out an update on our PEA. We had a net present value of $600 million and an after-tax internal rate of return of 25%. Very strong numbers for a base metal project. It has the potential to become a top 10 global zinc producer, producing one of the cleanest concentrates that'll be on the market. So it'll be a very sought after commodity. All of the infrastructure is in place. Pine Point was a former producer, produced for 25 years. There's an electrical substation on place. We've signed an MOU agreement for what's remaining on the grid for green power. There's highway access. There's a railhead within 70 kilometers. So everything needed for a base metal project. And so we're going to drill this winter drill campaign to convert as much of the resource base as we can to indicated. And in the second half of next year, we'll be starting our feasibility study. So it's we want to rapidly advance that project to meet upcoming demand, and we'll talk more about that later. In April of this year, we announced our intention to acquire from Glencore the Gaspé Copper Project. Again, a former producing mine in the Gaspé Peninsula of Quebec, mining-friendly jurisdiction. Again, the metallurgy is very well known. All of the infrastructure is in place. There's, again, a substation on site. It's also surrounded by about 60 megawatts of producing wind power, so that's also available. And highway access, and there's a railhead within 100 kilometers. So it has all of the ingredients to make a good, large copper project. After we announced in April, we came out with an inferred resource of 450 million tons at 0.31. We think we can increase that grade by about 10%. This year, we started a very aggressive drill campaign, 28,000 meters. And that meterage with some more, next year, we'll drill about 15,000 meters. We'll be able to convert that inferred resource to the indicated category and then start economic studies on the back of that. So we want to push that project as well very rapidly. As we shift towards a green sustainable economy, and after the COVID is passed, there's going to be a lot of infrastructure stimulus spending. It's been announced in the United States, and I'm sure there'll be more to come as time goes by. So that's going to increase demand for base metals. And in the case of today, we're at historically low levels of inventory. In the case of copper, there's quite a few projects that are known out there, but they're going to be similar to Mine Gaspé, large bulk tonnage projects. In the case of zinc, there's not that many projects in the pipeline. So supply will have a hard time meeting demand. So we foresee for both zinc and copper a significant rise in the price and we want to be ready for that rise. As we shift toward a green, sustainable economy, and after COVID and the infrastructure stimulus, there's going to be a large demand for zinc. There's a base metal deficit looming, as I said, especially for zinc, and almost an unattainable gap for copper with all of the decarbonization initiatives underway. So we're well positioned to capitalize on rapidly evolving markets with exposure to both zinc and copper. Gaspé Copper is it's the best development project on the east coast of North America. And Pine Point has, as I said, the potential to become a top 10 global zinc producer. So we're well positioned, and the markets are strong going forward. Thank you for your time.
Hi, I'm Brendan McDonald, CEO of Fireweed Metals. We're an exploration and development company focused on critical minerals in Canada's north. We have 3 projects: the McMillan Pass Zinc Lead Silver Project, the Mactung Tungsten Project, and the Gaynor River Zinc Project, located in Yukon and Northwest Territories. Our 2 main flagships, though, are the advanced and large McMillan Pass Zinc Project in Yukon and the Mactung Tungsten Project, which crosses the border from Yukon to Northwest Territories. When considering Fireweed Metals, there's really 3 main points to consider. First, and this is a very topical one for us right now, we have an extremely strong backing and a very, very healthy treasury. We are just closing a $35 million financing, 20 million of which is being led by the Lundin family. This is a family that has a deep history in mining, and we're happy to welcome them as significant shareholders. The closing of this financing will leave us with something around $40 million at the end of the year. This positions us to have our biggest and best ever year in 2023, and still come out of the year with a healthy treasury at the end of the year. So, we had an amazing 2022, and we're still waiting on the last of the results from our biggest ever drill program in 2022, but 2023 will be even bigger yet. And, the other important thing to consider, and this is something that's very topical and very much in the news, is that we are focused on critical minerals. Our MacPass zinc project, as the name would suggest, focused on zinc. This is a metal that, yes, absolutely essential for infrastructure in terms of galvanization, essential for automobiles, essential for alloys, etc., but also has such a key part of the green transition, specifically around solar panels and wind farms, and is one, a metal that we do see significant mine supply from China and a real need for a secure Western supply. Mactung, on the other hand, potentially a tungsten mine. Tungsten is a metal that, if you think zinc has an outsized production from China, this is a metal that 85% of mine supply comes from China. And, in an era of friendshoring or resource nationalism, this would naturally make a lot of Western governments nervous. And we see this project as one that can meet a significant amount of Western demand for what is an essential metal. Its unique nature in terms of hardness and temperature resistance means it's essential for many uses, particularly industrial uses. So it's not just the commodities, though, that are so critical or such an important part of Fireweed. It's that the projects are best in their class, right? So the MacPass Zinc project is a clear standout in the zinc development space, emerging as the best undeveloped zinc asset in the world. This is a project that we had a very large and healthy 2018 resource, but have added significant drilling since then, which we think will take it into the next sort of level and put it in truly rare air in terms of global zinc resources. It's a project that after years and years of drilling, we're still hitting our best ever drill results, including 124 meters at 12.3% zinc, one of the best, greenfield, zinc drill holes in a decade. We just announced that about a month ago. And Mactung which is adjacent to MacPass, that is a tungsten project that has is a beast of an outlier. It sits all by itself in terms of being an incredibly unique combination of scale and grade. This is a project that has had a historic feasibility study done on it, that has been through the environmental assessment with a positive recommendation. We really see an opportunity to fast track this to a refreshed feasibility through licensing to meet, to near-term production, to meet Western demand for this critical metal. All in, Fireweed is in such a unique position in this emerging sort of nascent critical mineral space because we have the best-in-class projects for two very important critical minerals. We are extremely well cashed up with a very, very strong backing, and we're going to have our most catalyst-rich year ever in the coming year. We hope you follow us, and we're always available for questions if you have any. Thank you.
Hello, everyone. It's my pleasure to be presenting to you the Grounded Lithium Corp story. My name is Greg Fanoff. I'm one of the co-founders and CFO of the company. We are an exciting story, upshot to tell you in the 6 minutes that I have or less, really are three main things. We are a lithium from brine company in Western Canada, certainly poised to take advantage of the global energy transition shift that we're all a part of as citizens of the globe here in terms of the EV revolution, electrification of the world, and any company that's in that battery supply chain industry, I think stands to make some substantial returns for investors. So that's the first point. Second point is, in these sorts of resource development companies, team is vitally important. As I'll explain in a minute or two, we're comprised of seasoned resource development professionals. Most of our roots come from oil and gas, which is completely relevant and a layup, if I may, when it comes to lithium from brine industry. And third, in resource industries as well, it's all about the rock. It's about the resource. If your resource is not great, then everything else becomes sort of ancillary. So in our case, we do believe we're sitting on top percentile resource for lithium from brine processes. So those are the three things. Let me just kind of delve into each of them. It should come as no surprise, I think, to most people that the electrification of the world is very important. And primarily, we're seeing a big shift to North America. It's no surprise as well that Asia has dominated that space for decades. North America is in a catch-up mode, certainly from a Canadian government perspective, but also from the United States. North America in general is looking to expand itself all the way through that battery supply chain industry. So I think as an investor, whether you play it on the upstream side, you play it somewhere in the battery manufacturing side, or you play it in the end user, which for the most part is OEMs, I think, again, to my point earlier, investors can make substantial rates of return. We are upstream. As I said, we are primarily comprised of oil and gas professionals. Many of us have started companies in the past, have successfully sold them for rates of return that investors would appreciate. And that's important. Lithium from brine, if you haven't had experience with it, really is fluid dynamics. It's all about assessing the potential of the reservoir subsurface. In our case, we are not extracting lithium and putting it into large evaporation concentration ponds. This is simply something that's closed loop in a sense that you extract the fluids from the basin, bring them to surface, put them through an extraction process, and then from there a refining or a polishing process, and then at the end of the day having created a battery grade lithium salt. So it's very simple in that point of view, but it does relate to a lot of the oil and gas practices that we've developed over decades here as a team. Team's important. And I would encourage folks listening to this presentation to look at our website for complete descriptions of all of our team. Greg Smith is our CEO. Greg Fanoff, the other Greg, is the CFO. Plus, then we're also complemented by another few folks that are extremely knowledgeable in their chosen disciplines. The third point that I mentioned is the resource. And this is where I think Grounded Lithium has done a yeoman's job in terms of how we've gotten started. To back up, we started this concept about 3 years ago, incorporated in October 2020, and we've been on a very fast track to get to where we are today. We've bought a bunch of land, we've gone public, which I'll talk about in a minute, and now we're moving to develop the project. We sit on roughly 300 sections or 300 square miles of land. Our land is in southwest Saskatchewan in a town or near a town called Kindersley. Saskatchewan is very pro-business. It's ranked second by the Fraser Institute in being friendly to resource development and to mining in general. We chose Saskatchewan not because of Saskatchewan itself, but because the rock took us there. To my point, in resource development, it's all about the rock. And Greg Smith and his technical team did a lot of work to assess where the lithium is basically created, how it flows, how it gets trapped. And in our case, we believe where we are has top percentile resource potential. And in fact, we issued a press release on Tuesday of this week that communicated some of the results from our first drill. That drill was done successfully on time, on budget. And time's relevant here in some respects as well, because this is very shallow compared to other parts of the formation, which are lithium rich. This is shallow, so that just means less drill time, less day rates, and ultimately less capital. And less capital gets to the point where, as a CFO, I like those numbers because that's better rates of return if your CapEx is less. So we drilled that well, and as we communicated in our press release on Tuesday of this week, we had very robust flow rates. In resource development like this, grade certainly is important, so your parts per million or milligrams per liter of lithium, elemental lithium in the brine. But just as important, maybe even more, is deliverability of the well. You need to have good grade, but you also have to have strong deliverability. And as we press released on Tuesday, our test well showed very, very strong rates of productivity based on good reservoir practices, which again, the team has loads of experience in that regard. We're communicating that we will produce wells at 18,000 barrels per day of brine. So you look at the 18,000 barrels per day of brine plus the grade, which is kind of mid 70s, which is very much consistent across the basin that you'll see from others in the same space in lithium from brine in Western Canada. That, in our view, even with a more conservative view of the lithium hydroxide or lithium carbonate price, which trades at a very steep premium today, even with a more subdued price, we would have a very compelling economic project. We're very charged. We're very excited about the prospects. We've come a long way in the last 2 years, which begs the question, where are we going? In 2023, we expect that to be a very pivotal year for us as well. We're working towards what's called a preliminary economic assessment, which I'm sure many of the viewers are aware of, but a PEA. The PEA will assess not only the quality of the resource, but also the economics. We are sitting on, as disclosed in our National Instrument 43-101, 2.9 million tons of lithium carbonate equivalent. We're in the process of updating that report. Stay tuned for future releases in that regard. So the PEA is something we're working hard towards. We're also in an engagement with Hatch Engineering to help assess the technology that we'll use to extract the lithium. Our chosen main source is direct lithium extraction. We aren't a technology company. That was not one of our founding principles. We are really good at resource development, and therefore with Hatch's help, we're looking to find the best technology to fit our brine chemistry and work out some sort of commercial arrangement, i.e. pay a license fee to a technology provider. So we're staying good to what we know. We're close to our knitting in terms of resource development, and let the others, as we say, stand on the shoulders of others to develop the technology. Wrapping up, we are a public company. We trade on the TSX Venture, symbols GRD. We also just recently got our quotation for the OTCQB. Symbol there is GRDAF. Would certainly encourage those interested to go to our website, www.groundedlithium.com. There's plenty of materials on there, videos, press releases, etc. And as well, we also have a subscription list. So if you're inclined, please drop us a note, add your email, and we'll make sure that you get our distributions. With that, that's a quick 6-minute assessment of Grounded Lithium. Thank you for your time, and we welcome you as potential shareholders. Thank you.
Hi, thanks so much for attending 6mix. Our ambition with this conference was to give you a 10,000-foot overview of the entire metals and mining sector as you enter into 2023. Over the past 2 weeks or so, over 100 companies have presented and shared their stories, their corporate updates, and they've done so with 6 minutes each. I hope that as a result, you now see the exciting breadth of activities that happened over the last 12 months and are now familiar with what's going to happen as we enter into 2023. If you'd like to learn more about any of these companies, you can use 6.com as a resource. We've launched a markets page where you can type in the name of any public company and access all of their financial data, corporate filings, etc., absolutely for free. We've also launched company pages where you can type in the name of any company you're interested in and see all of the video content that they've ever created through 6 directly living on their company page, and you can subscribe for updates. We've launched speaker pages where you can type in the name of any speaker that you would like, and from there, see all of the video content that they're producing and get notified of new updates, and much, much more. Thank you so much for joining us at 6mix. I hope you have a fantastic rest of the year, that your holidays are restorative, and that as we enter into 2023, we usher in a new bull market for the metals and mining sector. Thank you so much. And with that, I'd like to officially close the 6mix conference.